Test. Okay, sorry, I was working on technical issue there. Hi, great name. I'm Brian. Brian. Thank you. Oh. Before and rock that AI that rolls out when I do the blog topic. The one side of it, I think the 3D version that right there. All you'll need a research paper that's CFA quality, so that I can argue both sides of this issue, and we'll get started. Okay, that sounds good. Yeah, you're welcome. We can play around a little bit with it tonight because we're getting a little closer to that time of the semester, so we might as well be spending a little bit more time using some of the tools that are going to help us. I'll give it just another minute and then I'll get started. I just heard somebody chime in to the Zoom meeting. Can you give me a thumbs up or tell me if the audio is working okay on your end? And I didn't hear the audio and I didn't see the thumbs up, so I'm hoping that you can hear me. This is recording as usual. I tested the audio and mic on my end and it seemed to be good, so I'm going to go ahead and get started just with fingers crossed. Week 8 already, semester's flying by. Week 8, it's the completion, module 8 will be the completion of all the material that will be covered by the second exam. So I posted the second exam on my sports website, and I opened the window of time you can take it from anytime beginning now through March 31st. So you have a 3-week period of time. So that would be plenty of time for everybody to get in there, start the exam, about 2 hours to take it. It's 40 multiple choice questions over modules 5, 6, 7, and 9. Yeah. Any questions before I get started on module 8 about homework, exam, research project, markets in general? I'll take compliance. The market is pretty low. It has been pretty loud. I started getting not panic calls, but calls of concern from our clients. That's all. That's an indicator. Every financial advisor been doing this for any length of time that serves a client base. So I serve 200 households and directly and have to be probably 30 of those. So I have clients that I think of as indicators because they're highly attuned to the emotional ebbs and flows of the market. Call if they're so I know the market might have picked their bottom. And I also have some very astute clients are just good at moving in, moving out, and taking risk and stepping out of risk. So lots of volatility in the market. That's the key word, uncertainty. If you look at, I saw a blurb today, the Fed date, which is, we can think about the Fed date, but it's the collection of the anecdotal stories and evidence from around the economy. Mentioned the word uncertainty 47 times, which is very high, much higher. We don't have a playbook for tariffs. We don't have a playbook for persistent inflation. We don't have a playbook for Doge, and valuations are elevated again to begin with. So you put all that together without anybody having a crystal ball, and you see a lot of investors wanting to just sell their portfolios right now and move cash. And it's a reasonable decision, especially with money market funds yielding 4.5%. So that's my world. You made mention of it, so I thought I'd share. But yeah, any questions you have in that vein, I'm happy to take. As it pertains to class, though, just let me know if something comes to mind as we work through this material. Let me take off these. I like to. Okay. I want to figure out. I'm trying to remember which menu it is that I go into so I can take those animations off. I don't like the text flying in bullet by bullet. It takes forever to get through a slide. Gosh, I thought it was right here. I thought it was under slideshow. Maybe set up slideshow. Show without narration, show without animation. Okay, that's it. Okay, great. So tonight we're going to be talking about the equity section of the balance sheet, specifically common stock, preferred stock, retained earnings, treasury stock, and accumulated other comprehensive income, which we've touched on several times in this class, but we'll touch on it again tonight. As usual, I've scribbled down some notes that I want to make sure that I convey to everybody in the room and on Zoom. And I'll skip some slides that I think are a little bit. So let's start with stockholders' equity and some of the more common terms that you're going to see when you look at that technical account. You'll also be on the lookout for the statement of stockholders' equity in your 10K filing, and that'll come with some associated statements, and we'll look at it. Hopefully they are familiar with all of these things on how to read it. Our authors point out the stockholders section, stockholders equity, that is book value. When you hear investors talk about book value, they're talking about the section that outlines stockholders. So if you think about all of the little basic accounting equations, assets equals liability plus equity, well, you can take all of the assets, if you were to subtract out the liabilities, what you would be left with would be the equity. So you have contributed capital and earned income at the bottom of that slide there. So contributed capital is what it takes to start a business. Whether that's a car wash or a financial advisory firm or a library or a tech company, the owners, typically founders, are going to raise the pool of capital. And that comes, most entrepreneurs utilize the 3Fs. Anybody know what 3Fs are when you start a business? Friends, family, and fools. Because those are the sources of capital for first-time entrepreneurs. So you tap into your network of 3Fs, you raise a pool of money, and you borrow a little bit from the bank, and then you have contributed capital. And then as the business operates over time, hopefully you'll have net income, and that net income will collect in a pool that we call retained earnings or earned capital. And all that shows up on the stockholders equity section. This one's from Johnson & Johnson. So if we look at their balance sheet, 2022, we can see preferred stock, which we'll talk about, common stock, accumulated other comprehensive income. We're going to talk about that. Retained earnings. That's the sum total of a company's net income minus any dividends that might have paid out here. That's why they're retained on a quarter-to-quarter basis. The companies that report earnings, in other words, net income. And the portion that it retains shows up right here. Johnson & Johnson has retained $128 billion, $345 million worth of retained earnings over time. Theoretical question: where is that $128 billion? Where are they? So this is a first year accounting frame. If you go to work for an accounting firm with a newly minted accounting degree, the senior partners will mess with the junior analysts and tell them to go down to the vault and count all the retained earnings. If there are no retained earnings, all of that cash, which was at one point earned, has been redeployed. So the basic debits and credits, you have net income as a debit, retained earnings as a credit, and then the next period, that cash gets deployed into an asset or sales force or research and development or property equipment. It doesn't just sit there in the vault. So then we subtract off any treasury stock. We're going to talk about that and total shareholders down. So after we move through all of those categories, we basically will have a good understanding of what populates all of that, which is the way equity functions. So a little bit of terminology. Boy, I wish we could get rid of some of these terms. Preferred stock. I want you to think of preferred stock as, well, it has a couple attributes. First off, it's senior in the capital structure. If the business ever fails, if the file for bankruptcy and you go through dissolution, if there's anything left over, you pay creditors, That is for preferred stock. And then, if there's anything left over after preferred stock is paid, common stock will be paid. One of the reasons why preferred stock appeals to more risk averse. Another attribute of preferred stock that I really like, because it allows for this little tiny slice of the market that creates opportunity. Preferred stock functions like a bond in one key aspect. It's contractual in nature. You can design a preferred stock offering or a preferred stock issuance with almost any variety of terms and deal points and warrants and conversion features and cumulative yield features. It's really a white with regard to how you want to design preferred stock. And because there's no common template, my experience has been that it's a great place to look for illiquid deals. And when I say illiquid, they just like for Johnson & Johnson, they have $128 billion for retained earnings. You're probably looking at a $200 billion company. I don't know. Johnson is pretty big. But preferred stock issuance might be 10, 20, $30 million. So it's trading hands. Sometimes they only trade hands a couple of times a week. And when something's that illiquid, it creates an opportunity for a buyer who's patient to move in and make a market. In other words, be a buyer when somebody else needs to be a seller. And when you're making the market, well, you get to determine the price. Very often, you can pick up a preferred stock issuance on the cheap that'll have a great dividend associated with it, or maybe some conversion privileges that allows function like equity. What are a lot of those also sold on stock? Yeah, a lot of times it's just a over-the-counter transaction. So you have to reach out to your broker will call another broker. Like they're all electronically linked. So you put out a bid, and then that bid will get noticed by any other computers that are looking for a bid, and you can match the seller with buyer. Then the two brokerage firms will connect. That over-the-counter transaction will all be electronically reported. But that's one of the reasons why it's a great place to look. I found tremendous investing opportunities in for stock. Common stock, par value. Can anybody tell me what par value is? Par value is a relic. It doesn't really mean anything today. It's a relic of time when that's 65. I didn't even know what SEC. I don't know if SEC was. But the regulators, we'll just say the regulators have made the rules so that what par value used to be. Par value used to set a floor at which companies could not sell their stock below. So it's like some guaranteed value associated with the stock. And over time, it's really become meaningless. Just because now companies like Johnson & Johnson, they'll just issue a stock with a par value of a penny or a par value of $1. And they would never in a year sell their stock below that. But let's just make it a penny. That way we can sell our stock at any price we want to. And the difference between that par value and what they actually sell their stock at is based on market demand. And that has a name associated with it, which is additional paid-in capital, which must be on the next slide. We got that. So you will also see when you're looking at the shareholders equity section, authorized shares. J&J is authorized for $4.3 billion shares. Before you can issue shares publicly, you have to get permission to go to the SEC and say, hey, this is what we want to do. And it's big, I think it's called an S1 filing. It's typically 100 pages or more, detailing everything that you want to know about the business, how it's operated, who the management team is, what the major risks are. Great document to tell you a whole bunch about it. Check it out.
You know, I reading about this so that Delaware has tax.
Oh, yeah.
Yeah.
Okay.
For lower you can do it. otherwise I can't. 200 grand, I think they capped it at 250 grand for like 45.
Okay, good. So again, deviation from the original intent, that makes the whole thing rather meaningless at this point, but that's a good nugget. Thank you, Sharon. And then you have issued shares, these are just data points and then treasury stock. We're gonna talk about that, but when and if a company decides that it's to their advantage or for any reason, that they want to buy their shares back, it's gonna show up in a category called treasury stock. There's a variety of reasons the company might want to do that. That will get to. Accumulated other comprehensive income, you've heard me refer to this category of the section of the stockholders' equity as the junk drawer. These are the highly volatile items that FASB has deemed will make the financial statements rather useless if we include them on the front page because they're so volatile. So we have to take account of them, we have to record them, we have to give investors that information, but we want to present it below the line. And in the base, other accumulated comprehensive. Last little thing that we're going to talk about all that. Book value per share, I just quickly wanted to touch on this formula, you might star that. We're going to take stockholders' equity less any preferred stock that the company has issued. We're going to treat that like a liability. Then you divide by number of shares outstanding to get the book value per share. And then one of the most common metrics that is used in finance in general is the ratio of market value. So think about market value is that's basically price. Take price per share, multiply that with the number of shares outstanding. You get the market value. Theoretically, take your wallet out, write a check for that market value, you can buy it. Compare that to book value. If market value is the numerator, then book value is going to be the denominator, and that's what shows stuff on the balance sheet. Those two numbers differ wildly, as we've discussed several times, because the market is willing to pay what the market thinks that business will generate in the future. So a company like Apple or a company like Meta or a company like NVIDIA, the value of their property, plant, and equipment is only a very small indication of what that company is going to generate, because they've been able to build distribution chains, they've been able to collect intellectual property, they've been able to acquire other businesses through M&A that have added to their value, and done all these things to create value that aren't properly reflected on the balance sheet. But they will be reflected in market value, or at least market value reflects the average opinion of the investor buying the stock today. As we know from last week, that opinion can fluctuate wildly. Oh, let's see where I'll go next here, fairly. Find this bottom table, that's my only note on this slide. It's in the 10K filing. I'm going to detail how the major sections fluctuate from period to period. Okay, the first step, I already mentioned it was contractual. I mentioned that it has various privileges, rights, features. Two of the most common on slide 10 here are yield and conversion. So generally, the basic bargain is you're going to get a higher yield than you would not say the common phase of the game big common stock. A preferred stock issuance probably in 4.5, 5. And you won't get as much cost. Maybe you'll get so for investors that are maybe retired and have a steady income or need conversion, sometimes, not all of it, in addition to a higher yield, you'll get the opportunity to tag along on any excess appreciation. They usually do something like that. Johnson & Johnson will agree to pay an investor a 4.5% dividend, and you can get the any appreciation in the stock above a certain threshold. So if the stock's at 50, you'll get to participate in any appreciation above 60. So you don't get the 56, but you get a 4.5% dividend yield body weight, and if the stock does well, then you'll get a 4.5% dividend yield plus the appreciation over a certain time. Okay, that is a certain. And those different features, obviously, if you would freeze them, make that investment more or less correlated to the general stock market and bond market, and therefore help portfolio managers develop more efficient portfolios for investors across the spectrum of an efficient portfolio for 25 different from an efficient portfolio for 65-year-old. Example of what I just outlined there. Can occur. That's it without comment by yours truly. You could have here two. I want to discuss the dynamics of treasury stock. So in this slide, in this example, we're looking at Johnson & Johnson's common stock. Today, J&J has repurposed what looks like 506 million shares for $41 billion. And just like we looked at in the prior slide, those shares are held in treasury. So you're going to be able to see those shares on the statement of shareholders. Non-controlling interest. Non-controlling interest, you might recall, shows up on the balance sheet anytime we're dealing with a conglomerate. So a company that is bought. Well, let's just use Berkshire Hathaway. Berkshire Hathaway is a conglomerate, and they bought hundreds of different businesses and try to buy from original founders and Nebraska Furniture Mart. Berkshire Hathaway bought Nebraska Furniture Mart over a decade ago, and it was it had been built by and was still run on her name will come. She was this elderly lady that positioned herself as a kind of like a grandma type figurehead of the business. And anyway, when Berkshire bought the business, let's say for sake of argument, they didn't buy it. Well, if you buy 90%, then the accounting requires consolidation. So you will report 100% of the revenues. You will report 100% of the assets. But you don't actually own 100% because you only bought 90, which means there's a minority shareholder out there somewhere that has the legal right to that 100%. When that instance occurs, we have to report something called a minority. So we consolidate the balance sheets. We report all of their assets and all of their liabilities. And then in the equity section, we book a non-controlling interest that represents the value of that. 2 points here that I wanted to share. The last 2 bullets. The non-controlling interest account increases by any additional investments made by the non-controlling shareholder. The one that's not always as intuitive is that it will decrease by any dividends the company pays to the non-controlling shareholder, which also happen to be the same dividends that they would pay to the controlling shareholder. So if you're a stockholder and you get a dividend, that's also paid to non-controlling, which means we have to adjust the value of that non-controlling. Okay, now let's put on our analyst hat, which is what this class is all about, statement analysis. And let's talk about any instances where we might have to adjust the numbers for this non-controlling interest value of 250. So the total equity is 10,000,007. I think we're talking about General Mills here. The total stockholders' equity is 10,400. The non-controlling interest is 250. So the total equity is 10.7. When you're calculating your ratios, you need to have a familiarity with the numbers that you're using and why. The question that our authors asked on this slide is, which one of these numbers do we want to use? Do we want to use the total stockholders' equity, or do we want to use the total equity? Remember, minority interests, they don't own publicly traded shares outstanding. That would make them part of the stockholders' equity. They own a minority interest, but it's not publicly traded, because they've held on to that through some M&A activity of the past. So, put your analyst hat on. If we want to calculate return on equity, which one of those numbers do we want? And our authors tell us that we want the equity attributable, which means this one right up here. So total stockholders' equity. And why would that be? Well, reason why we want total stockholders' equity is return on equity has net income in the numerator and stockholders' equity in the denominator. And those two things are going to match because net income has already been adjusted for the portion that belongs to my minority interest shareholder. Leverage ratio. Well, in the numerator, you have, just call it total debt. So in the denominator, if you want those two things to match, which one do you want? Total equity. This total debt, in this case, comes from a consolidated set of financial statements that includes the debt of all acquired companies. And then lastly, if you're looking at market to book ratio, you'll want to use the equity attributable because market in the numerator means the market of publicly traded stocks outstanding times the price to get market capitalization, which would exclude the interest of the minority share. Okay, 8.2. Issuances and repurchases. Let's go straight to repurchases. Issuance is pretty straightforward. You can handle that one on your own time. Let's look at stock repurchases. I want to spend just a moment on this slide because my experience has been that what I was taught when I was sitting in your seat at the law school studying for my MBA program, it's not always. And even though I'm sitting, I am very skeptical. I see. And what I was taught was that stock repurchases theoretically are a signal when company management, insiders that are running the company that know more about the company than anybody else in the world, as they should, because they run the place. When they choose to buy their own stock, that's a strong buying. Because they're smartest people about that company. So when they buy, the market should take it as a signal, and that's a good time to take back on their trade. My experience has been there's all kinds of reasons management teams buy that have nothing to do with it being a signal. Great buying with their general public. One of the reasons why we play this one game of follow the penny. We start this class off with a study of the problem data, so we can know how to manage concerns. Buy your own stock back. That comes all kinds of ripple effects with ratios and other reporting criteria that can be linked to incentive comp. And when that's the case, the whole buying signal theory, well, you might as well just throw that in the trash. Now there's, as soon as management learn how to pull these maneuvers, the buying public educates themselves, they come together. Everybody's trying to outsmart. So, it's been a while since I looked at this company that was called insider something, insider info. And it was a free service for a while, and when it was launched, it was brand new. It was like this little, it was way before alternative intelligence, but at the time it was like an algorithm. And algorithm monitored a whole bunch of different things, heat up over time. And as it heated up, it was supposed to give you an indication of what a true buying signal would be. So not only did it look at all insider buying, but it looked at individual buying. So if everybody in the class is a manager of Johnson, then this gives us, we track all of our buying. Company buying, all the insider purchases, and it would correlate them to the stock price. And it would know if I'm buying to fund my daughter's wedding or buy a vacation home, well, that's personal. It might not have anything to do with the value of the individual. But somebody else is gonna be a really savvy buyer. And this business would correlate all the insider tracking and it would say, okay, well, when Vern buys, pay attention. Because 9 of the last 10 times he's bought, the stock's gone up by 5% in the next 30 days. That's interesting. So that's a real signal. Okay, last 2 bullet points on this side, on this slide. When a company doesn't buy the stock back, it reduces the size of the company. And it can result in a negative stockholders' equity balance. Buy your stock back. Especially if it's the price. Gotta reduce the equity balance, your balance sheet. See, aggressive. They can actually take that account negative. And when and if you see a negative equity account, you're gonna have to make some adjustments because a lot of the ratios that we talk about in this class have some equity in the denominator. So none of those ratios will be of any value whatsoever if the company pushes its equity account into the negative. In that instance, what I recommend you do is put your analyst cap on and make some adjustments so that you can use the numbers in a meaningful way. One of those adjustments would be to reverse all of those treasury stock transactions so you can view the company through the lens whereby it never happened. This is what the company would look like if it never happened because we've reversed all of it. Continuing on with that theme, when and if you see a negative equity balance. I'll often recommend that what I just mentioned. Compute a ratio like return on equity after adding back treasury stock. And then another option is to number 3 here, substitute the market value of equity for the book value. And that allows you to compare apples to apples across, look at JJ, compare that to Abbott Labs or some other medical device manufacturer in the industry. You can use market value as an apples to apples comparison, depending on what your use case is. Okay, market compensation. Again, we're going all the way back to class number 1, where we looked at proxy. And it was everybody's assignment to understand the incentive-based compensation plan. So providing you credit proxy and good understanding of those we look at. A lot of it sounds familiar. The intent here is to really create incentives that align management's efforts with those of the stock. The only way to really do that is to give the stock, give them stock, then their stockholders and your stockholders. But the problem is, it has to be meaningful enough to align their behavior as if they were an owner. If you're an owner of the business, most owners of the business, most business owners that I talk to have 50 to 70 to 90 to 100% of their net worth tied up in that investment, in that business. That's impossible to do for a newly onboarded man or newly onboarded. So you get that's looks like restricted stock or restricted stock units or employee stock options or stock appreciation rights or an employee share purchase plan. Every one of these is just another contractual relationship that has the goal of tying a management team's efforts and goals to the goals of the shareholders at large. And they all have different vesting schedules, and they all have different strike prices, and they all have different features and benefits. And they all fall short of the true goal, which is to align management's efforts with shareholders. The only way to do that with any certainty is to hire an honest manager. Dr. Clark has this theory that we shouldn't teach. Which I lie. It's a shocking theory. So which is why it sticks in your mind, but I probably don't represent it. But he has a point. In the business community, we shouldn't even teach ethics. What we should teach is contract law and incentive law. Charlie Munger has a famous quote that something to the effect of, almost representative, something to the effect of, show me an incentive and I'll show you the outcome. And for anybody that's been in business as long as Charlie, we have enough observation points to tie all of these actions and reactions together in a predictable sequence. So if you give a management team a certain incentive package, don't be surprised when lo and behold, they optimize their behavior to create and maximize their income. That's what they should be doing. And because there's not perfect alignment in here, we teach this class on all of the different scenarios that arise, that create opportunities for manipulation, gamesmanship, and just general change. Which is why every time you see the word estimate, accounting, we call it introduces uncertainty. It introduces human error, and it introduces the opportunity to gain the system. Okay, moving on. Analysis of stock-based compensation. When you see any of those that we just listed on the prior page, it's our job as accountants to understand how that ends up on the financials. We need to look at that as an expense. When we reward an incentive, man, that costs us. And it's confusing because it's usually a future cost. These are non-cash outlays. When I issue a management team the right to participate in any future appreciation of the stock, what I've effectively done is diluted my claim on future earnings of the shareholder today. That makes sense. So we need to make sure that ends up on the income statement somehow. That's also going to result in potential dilution. So we need to make sure that ends up in our analysis somehow. And we have ways of adjusting earnings per share where we can report diluted earnings per share. Diluted earnings per share does exactly that. It takes a look at all this incentive comp options, other forms of naming that question. Okay, what if those were exercised? Because they will be exercised if they're of any value. So if the stock price goes up, they reach their strike price, all those options are going to be exercised. And all of a sudden our earnings per share, maybe it's $1 more, now it's $90.
We have to share the phone. Legal plan.
J again. Yeah, J. Look at their stock-based compensation. You're not likely to find this on the front page of the income statement. You're gonna have to dig through the 10K filing. In this instance, it is shown on the cash flows from operating activity. And you see stock-based compensation. Now, why would it show up on cash flows from operating activity? Well, if you'll recall how we compare a statement of cash flows, we begin with net income. So this, we call J&J's net earnings here are 17.9 billion. And we recognize that by beginning with net income, we need to reconcile for any non-cash expenses that lie within net income. Our authors start with depreciation. We all know that's a non-cash expense, and stock-based compensation. That's a non-cash based expense. And to a certain extent, we can treat it like depreciation. We know depreciation is not a real cash-based expense, but we also know if we spend 100 grand on a truck, then 10 or 15 years later, at the end of the useful life of that truck, it's not worth it. So we use up the partial life of that truck every year, and we record that as depreciation. It's kind of a real cost, because we need to accrue for the value of that truck, so we can replace it in year 15. We don't accrue for it with some expense. Well, then we're misrepresenting the economic reality. We need to accrue with some expense for stock-based compensation of $1.1 billion. How do we do that? Well, we do that by estimating the fair value of the expense. There's that word again, estimate. Stock option plans are valued using option pricing models, either the Black-Scholes model or the bilateral lattice model. You'll recall what class we had that derivatives. Okay, right. Okay, all right. So if you're trying to play this little game of follow the penny, and that class kicks your ass, then it's a logical leap, logical conclusion that there's a lot of investors that are going to be a little foggy about the inner workings of an options pricing model or a Black-Scholes model, both of which take assumptions to navigate. So there's a whole world of opportunities. First off, swap between valuation metrics that will, depending upon which one gives you better data, this quarter or that quarter. And then also to tinker around with the underlying estimates to go into both of those models. Any one of those levels will change the expense, and if you can change the expense, you can change the bottom line earnings, you can change most of the metrics that are tied to your incentive function. We don't go into those models in this class. I'm just pointing out that's another layer, another opportunity for confusion to be, the seeds of confusion to be sown. Stock dividends and stock splits, pretty straightforward. What we're talking about with stock dividends and stock splits is one pie, and the question is, how many slices do we cut? So stocks. We have 100 shares outstanding, and they're trading at $10 a piece. Let's start with 100 shares outstanding, they're trading at $1,000. $1,000 spent. And the theory is that companies can support their stock price and their price to earnings multiple by increasing the number of buyers that might want to buy it. So that makes perfect sense. The bigger your market, the higher your demand, the higher your demand, the higher your price. Okay, great. Well, if all those things are true, then we want to try to keep our stock price within a desirable limit. So if it appreciates to $1,000 a share, we might say to ourselves, well, we want that at $500. That's easy to do. Have five million pieces. We have, we just stock split, we issue stock split, we split it 2-for-1. Voila. We have 200 shares outstanding. So you're logging into your Schwab account. Yesterday, you log into your Schwab account, you see 100 shares a day. Today, you log into your Schwab account, you see 200 shares a day at half the price. Generally pretty meaningless in the markets. I don't think there's a lot of great research tying that theory back to real price increases. You all know I'm a fan of Warren Buffett and Berkshire Hathaway. Warren shares the same opinion I do, or probably vice versa. I share the same opinion that Warren does. I don't recall Berkshire Hathaway ever having split their share price. And I think today it trades at $600,000 a share for an A share. I'm checking on that. But if you're an A shareholder, you're big. Stock dividends are the same thing. But I view a stock dividend as a red flag. Because they typically unfold like this. If a company has been issuing dividends for a long period of time, likely that they have attracted a shareholder base that relies on that dividend. If you're getting a dividend check in the mail every month, it's likely you attract the shareholder base of people who live on that dividend or are attracted to your stock or the income that it generates, especially if you're a retiree. We build dividend paying portfolios for a lot of our clients. Like cash for the dividend checks. Every month, every quarter. When a company stops paying the dividend, you see shareholder churn. The investors that own that stock, dividend, they sell that stock. What happens when a lot of investors sell at the same time? Well, now you have selling. They're facing supply and demand. You got excess supply, so the price fall. Companies know this. So they're very hesitant to cut their dividend. They try to keep it alive at all costs. And as a last measure, what you often see is that a company won't pay a cash dividend, they'll pay a stock dividend. And rather than give you, I don't know, maybe they say the dividend was $1. Instead of paying that in cash, they'll give you another $1 for the stock. Which is, again, the same basic question. How many pieces are you cutting the pie? Because if the entire shareholder base gets a 10% stock dividend, well, you just added percent shares outstanding, didn't create any economic value whatsoever. I think it's a complete shenanigan, but persists in the market. Okay, let's move on to. The jungle, accumulated other comprehensive income. I want to go down the list of the 5 major components that we typically see in accumulated other comprehensive income. This is everything. Look on the supplemental schedule of accumulated other comprehensive income filing the company that you're looking at. But the major categories, firstly, include foreign currency translation. This is huge for a company like Apple. Apple operates across the globe. I was listening to an economist article on my way down here tonight about Apple building plants in Indonesia. Because Indonesia told Apple they couldn't sell phones in Indonesia unless they manufactured some of their products. So now Apple is building a factory in Indonesia, so they can sell phones in Indonesia, and they're gonna sell those phones in. What's the? It's all phone in Indonesia, they're gonna flash that in currency, and they're gonna do that in a subsidiary that's legally registered in Indonesia. And at the end of the year, they're gonna have retained earnings, but those retained earnings aren't gonna be US dollars. They're gonna be Indonesian dollars. And we as investors in Apple are gonna go to Apple's investor related website, we're gonna get it printed from the 10K filing. And at the bottom of the income statement, they say, well, we made this in US dollars. And we're gonna say, hey, wait, we didn't make that in US dollars, and some of those were Indonesian rupees or whatever. So at the end of the year, we have to go through this big accounting adjustment, this big translation adjustment, where we take everything that we owed over in Indonesia, we translate it into US dollars, and we build the financial statement. Well, when we do that, say Apple's only 60%, only 60% of sales come from the United States. That means 40% come from international. So 40% of their sales, 40% of everything we see on that balance sheet, is actually another currency, which means that it's accurate for one day. Number 30. That's the day when we enter the currency. What happens the next day? That currency fluctuates. And it fluctuates in a big way. So this translation adjustment can make a huge difference. The numbers I just told would indicate that 40% of Apple's balance sheet is price. And if the dollar was on a huge run there for a while, and it's backed off with the tariff talk here just recently. But let's say it's appreciated significantly. If the dollar is appreciated significantly, well then everything that we translate from foreign currency to US dollars is going to probably show up year over year, probably going to show up. And if you book a loss on 40% of your business, that's going to dwarf any other line item that we report on the income statement, which is why we show it as accumulated other employee benefits. We've talked about that in the past. Defined benefit pension plans, those are all the liabilities that we own to workers that have accumulated the right to a fixed plan, sometimes over decades. And when a company has decades worth of service that they've given to the company, in exchange for that, these retirement benefits can number into billions of dollars. You have $10 billion parent plan liability. I think Boeing, if memory serves, Boeing has the largest defined benefit plan in the country. It might be defined company for the sake of argument. Let's say they have the largest defined benefit plan in the country, and it's over 50 billion. Well, say you go through another quote, market fell by 20. 50 billion and 20%, $10 billion. Boeing can't put $10 billion off. That makes everything else look ridiculous. So what they do is they take the $10 billion off. They put it in other comprehensive income where everybody see to go look at. But if the market does what the market does, it'll rebound because the next year that entire loss goes away. And that makes a whole heck of a lot of sense for segregating off something like defined benefit pension plan. Gains and losses on marketable securities. My underline available for sale debt securities. That's the only category of securities whose valuation change from period to period shows up in other comprehensive income. Gains and losses on derivatives and hedges. The gains and losses that show up on derivatives and hedges are entirely dependent upon this word hedge. Southwest Airlines, for example, their largest expense is fuel. Fuel is very volatile. But Southwest Airlines, they hedge that cost. Okay. If it's a proper hedge, then any gains and loss on those forward contracts or futures contracts that Southwest Airlines uses will show up in other accumulated comprehensive income. If it's not a proper hedge, then it's speculation. If it's speculation, it's taking random betting positions on the future of this commodity or that commodity, well, that makes you a futures trading firm. And if you're a futures trading firm, that's part of your business. And if it's part of your business, then those gains and losses should flow through net income. If they're normal part of your business. Look for this table, find this table in your 10K filing, it's gonna outline all the major categories of accumulated other comprehensive income and how they've changed over time. This is a great place to do a little fishing for value. You might look at. You might take a position of dollar, you might think dollar is a long-term secular trend. General working theory on any of these categories is that they go up, they go down, they ebb and flow, and over time they block. That's an oversimplification, but yes. Well, you might take a position on the long-term attractiveness of the dollar and come to the conclusion that some of these gains are real, some of these losses are unlikely to persist, and therefore they represent some hidden source of value for the rest of the market and discounting that create an opportunity for whatever it is. Let's move on to earnings per share. I think we are about there for this evening. Earnings per share. I mentioned that the calculation of earnings per share is accompanied by diluted earnings. Talk about incentive comp, talk about shareholder compensation. All that factors into the calculation of earnings per share. So we have the basic calculation that begins with net earnings divided by shares outstanding. And then we break it down into the constituent components. So let's look at the green first. Take these one by one. Net income less preferred dividends divided by weighted average common shares. And then to calculate the diluted earnings per share, we're going to subtract off the impact of options and warrants and the impact of any diluted convertible securities. See, 2002, they began with a basic of 683. Average shares outstanding were 2.6 billion. Then they calculate the potential shares exercisable under stock option plans, which is 140. And then they subtract the shares repurchased under the treasury stock method of 101. And this is a very common technique. To say one of the best ways that we can track dilution or do expense for it is to just go back into the market and buy back the number of shares that we think are going to be diluted. So a little bit of a shell game. They give the management team these offers. They calculate the potential dilutive effect. And then they try to buy back in the public market that number of shares which corresponds to the potential dilutive effect. And in my mind, I think wouldn't it be easier to take the number of shares that you buy back in the market and give it away to your management team? Maybe they all do it for a reason. One of the reasons is that they all have different vesting periods and contractual rights and obligations tied to various metrics and features that have positive effects. At any rate, that's how they do the calculation, and then they have the adjusted average shares outstanding, on a fully diluted basis, and the diluted earnings per share. So the basic was 683, the diluted is 673, and that touches on a concept that has come up several times in the semester, which is materiality, whereby as an analyst you may just say, It's not an accounting class, it's a finance class. So with finance class, the only reason we do any of this has to be tied to a specific use. So you're asking yourself, okay, what's the use case? Are you doing this to the banker? Are you doing this to the creditor? Are you doing this to the investor? Are you doing this to the corporate strategist? What is your role? Okay, in that role, how do you use the accounting? Yeah, first you have to understand the accounting before you can use it. Then, in that role, how do you use the accounting to support your decision making? Big part of that is materiality. So you can look at something like earnings per share, you can look at something like the dilution. You can look at something like fully diluted shares outstanding and say, well, for what I'm using these numbers for, a 10-cent change from 673 to 683 is not material. So I'm start. And I've encouraged you all to do the same thing as we methodically work module by module towards this research project. If you get to a module on leases, your company doesn't have any leases out, or they have $1 million of leases out, and if the market cap of that business is $700 million, it doesn't make any sense. You can spend any time analyzing those leases outstanding and what they're going to do your ratios and what kind of adjustments you can make so you can compare apples to apples to your peers. Because it doesn't matter. It's not material. It won't affect your decision making. Just move on. It's not an accounting class. This is a finance class. So how do you get good at finance? You get good at finance by quickly zeroing in on what matters to the use case that you have in front of you. Big part of identifying the use case with accounting metrics is material. And that's it for tonight, folks. Let me end with any questions and then I'll send you on your way. I put an extra 10 minutes back in your pocket there. Okay. Thanks, Zoom crew. That's it. I'll see you all in a couple weeks. Exam 3 is ready for you. Go take it.